All right, thanks everyone. Really excited to have you here today. My name is Dr. Rebecca Mears. I'm with the VIN Foundation Student Debt Education Team. I'm going to help to get us started off here today, and then we'll turn it over to Dr. Tony Bartels. I did want to thank ACVIM for joining us as well as putting on this series of events. This is actually our final wrap up today with the ACVIM candidates. So Marion, thank you so much for helping us to put this on.
Thank you guys. It's been an honor to work with you.
Awesome, wonderful. So for those of you that are joining us today, we'll be getting started here in just a second. We do try to keep the chat open for any technical issues. If you have questions during the presentation, feel free to use the Q&A. You can also upvote those questions so that way we know which ones are kind of the most relevant to what's going on, and we'll answer those through the presentation as well as at the end. For anyone that is getting CE today, we'll have a form for you to complete at the end of this session. You do have to attend live in order to earn CE credit. And then your CE certificate will come from Jordan at vinfoundation.org. We will also be sending out a follow-up email in the next couple of days that has a link to the recording, the presentation, so that you have all of the links and some other helpful information. That will come from studentdebt at vinfoundation.org. And I'm really excited to, get you kicked off with some great information. So I'll turn it over to Tony now.
Thank you, Rebecca. And thanks everyone for joining. And for those of you that submitted those concerns as part of your registration, I went through and I combed through those every time I do one of these, and I change the content based on what I find in there. And I've peppered a lot of that information throughout this presentation. And this group in particular, I think has some very let's say unique challenges, right? And I've been super excited to do this one, and I think the timing of this is perfect, although time is short on some of the benefits that we're going to talk about. So for those of you that are attending, you're going to be able to hear about that and examine your student loans to see if there's anything that you need to do specifically before the end of this year. But I'd also encourage you to pass that word along to your colleagues, right? And because this group, again, is one of the ones that I'd say concerns me most. I mean, you guys tend to be some of the busiest, and it's really hard to get this kind of information into your schedules. But again, there's this time-sensitive information that's really important for you all to act on in terms of setting yourselves up for loan repayment success. And with the restart of repayment and the restart of interest, all of these things are very critical in terms of how much money you end up saving or paying towards your student loans in the long run. So we've got a lot of experience with this particular topic. I'm actually married to a small animal internal medicine specialist, and we learned a lot about what to do and what not to do with her student loans as she was going through her residency. But we've also, Beck and I have also gained a enormous amount of experience just working with our veterinary colleagues as well as specialists throughout the educational time frame on what to do and what not to do with your student loans, right? So this is an excellent opportunity to ask questions and also kind of follow through in some of the tools that I'm going to share with you so you can look at your own student loans and ask those questions while we're here, right? And even if you can't, I'm going to make sure that you guys know where you can get that help. I also want you guys to all be aware that anybody who's doing a residency at an academic institution or any academician has free access to VIN, right? So that was one of the things I was kind of looking at when I saw the registration list, is I saw a lot of you don't have active VIN memberships and it's free, right? So, and there's just a ton of information on there, not to mention the student debt information, which is accessible via VIN, but it's also accessible via VIN Foundation, whether you're a VIN member or not, right? So, and those of you doing private practice residencies, the price for that VIN membership is comically low. So, if you guys don't have that access, I would encourage you to activate that at least for your residency and beyond. All right, so this is what I'm going to try to cover. This is what I saw as a theme of the questions and concerns that came out of your submissions for the registration, right? And this is what I've kind of boiled them down into. So first thing we need to know is, what is the current status of your student loans, right? This has been very confusing to know with the restart of repayment, because many of you may have already been using an income-driven repayment plan and your payment was zero, but then we had the pandemic forbearance benefits, which also set your payment to zero. So it's really hard to tell what your status of your student loans are. Now, with payments starting last month, October, you would have found out pretty quickly if you had a payment due that was greater than zero, right? So some of you may have figured that out on your own, but then also there's a complicating factor specific to candidates, where if you're doing an academic residency in particular and you're doing a master's of clinical science or some kind of schooling along with that, sometimes that tends to push your loans into a deferment, which will also set your payments to zero and can be difficult to discern from a forbearance or from a $0 payment under an income-driven plan. So those are things that we really need to tease out, because all of them are very important and some of them are not very helpful. Right, so we're going to talk about that. What repayment options are you eligible for? That has never been more important, particularly with the changes that have come about. It will really set the stage for which repayment plan you can or should be using for the duration of your training and then thereafter. Should you use a direct consolidation loan now? That's probably the biggest one, right? So this is the one that's very time sensitive. There is a very, very beneficial, very special one-time forgiveness count adjustment benefit that is available. So if you maybe didn't do, what we would consider to be the best thing with your student loans after you graduated veterinary school, this is a great opportunity to clean up that mess or missed opportunity. Also, if you had some loans from before veterinary school that had some repayment time on them, you're really going to want to consolidate those loans before the end of the year, right? So that's something that we'll look at specifically when we get to the student loan physical exam portion. So I can show you what you should be looking for to determine whether or not you should be consolidating your loans, particularly before the end of this year, right? The time part is really crucial there. How to minimize your interest. There was a lot of questions about interest in the submissions for the registration for today. So I'm going to show you how you can minimize that interest accrual during your training period, why you should never defer or forbear your loans during an internship or residency, right? So this was another common theme that I saw. It's been one of my career goals, if you will, in the student debt aspect, to make sure no person defers their loans after they graduate, right? Sometimes it happens automatically and it's hard to prevent, but other times it's just because it's like a reflex that's built into the advanced training community. Your peers or your colleagues ahead of you deferred or forbear their student loans, so they tell you to do the same thing, and that's just it's not the best way to handle your loans, right? Deferment and forbearance has been made obsolete ever since we've had these income-driven repayment plans, but particularly now with the newer ones that are available, right? So I saw a lot of questions about, should I make payments? Should I defer or forbear, or what's the pros and cons? You should never defer or forbear your student loans during residency training or internship for that matter. So we'll talk about why that is, but that's a pretty kind of hard and fast rule, right? So I have yet to find in the thousands and thousands of consultations I've done with our colleagues any good reason for anybody to defer their loans rather than using an income-driven plan. So maybe there's one that lives out there, but it's really, 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 really rare, right? So so far that never has held up. What's the difference between public service loan forgiveness and income-driven repayment forgiveness? I still see a lot of confusion around that, but some of you are going to be eligible for public service loan forgiveness, either for your residency right now, and particularly for those of you that plan to stay on in academia or work for a nonprofit after you finish your training. So how to navigate, this is probably the most common question, was what do I do after I finish my specialty training, right? So I'm earning a residency salary now. What happens when I'm earning a specialist salary, right? And we'll talk about exactly how to navigate that post-training income bump. And then also figure out if you're likely to reach any kind of forgiveness. What the last several years with the pandemic forbearance benefits, the current one-time forgiveness count adjustment, and the recent changes to student loan repayment options, they're really kind of giving out forgiveness time like candy. And forgiveness time is extremely beneficial, right? So even for those of you that might end up earning $500,000 a year as specialists after your training, there's still a very good chance that you'll reach student loan forgiveness because of how much time you might have towards forgiveness by the time you get to that point. Right. So just because you experience an increase in your income doesn't mean an income-driven plan isn't going to be helpful for you, right? Particularly if your student debt is at the higher end of the spectrum, right? So all of these things are going to be very important when it comes to determining which repayment strategy is going to work best for you during your training and then after your training as well. All right, so why now? And this is a kind of an illustration that I like to use, particularly for those of you doing internships or residencies, and it's because you probably don't have a time machine. I mean, I know I could really use one, right? I know many of you probably wish you had one just briefly, but when it comes to student loans, you actually received one. So we have had access to a bit of a time machine to correct a lot of the common mistakes that most folks who go through advanced training make with their student loans, right? So you guys have a very, very rare opportunity here before the end of the year to clean up some of those mistakes and potentially boost your forgiveness time, which again makes it more likely that you'll reach forgiveness even after your training and your income bump. Plus, with all the changes that have come about, we definitely want to make sure that people are aware of those, what they mean, and how they can use those to their benefit, and those new strategies that will be coming about because of these particular recent changes to student loan repayment options. And just from the folks that in the past that we've met with, they all have, there's kind of a common theme here, as I wish I would have known this information earlier, right? I mean, I know you guys are buried when it comes to just trying to navigate those residency responsibilities and the education on top of that. But this is important stuff, right? These are your student loans, right? And a lot of you have to be an active participant, otherwise you kind of miss out on a lot of these benefits, and it just costs you more money in the long run, right? More money and stress when it comes to student loan repayment. We are going to try to tap into your clinical brains, right? And try to approach this clinically. So we're going to do a physical exam, a diagnostics of your student loans, and then from what we find in there, we can dole out some prescriptions and treatment plans. So that's the goal for this afternoon. If you do need help beyond this, we do have a way for you to receive that, and I'll illustrate some of that along the way. But we've got a student loan help page on the VIN Foundation universe that kind of walks you through it, right? It really makes it easy. If you have an active VIN username and password, you don't need one, but we still need you to have some kind of credentials so we know that we're helping a veterinarian. And then it's ultimately the best way to get the detailed analysis is to fill out what I call a student debt and income signalment form, right? That's what allows us to get the information that we need to really dig deep into your circumstances and provide some relevant recommendations in terms of what you should be doing with your student loans. And we use the message boards on VIN to accomplish a lot of that. And I'll show you how that works as well. So what does this student loan physical exam look like, right? We're really trying to figure out what types of student loans you have. Right now, the majority of your loans are probably going to be in the direct family of student loan types, right? There's a bunch of different subtypes, but most of you are walking around with direct unsubsidized or direct grad plus loans. If you have loans from undergrad, some of them might be direct subsidized loans. If you're a career changer, and you were in higher education using federal student loans anytime before July 1st of 2010, you might have these older federal family education loans. They were the precursor to the direct loan program. These are the ones that have been problematic, right? So if you do know that you were in higher education, you just using student loans around that date time frame, then make sure that you're checking to see if you have some of these older loan types. These are the types of loans we're looking for when we want people to consolidate before the end of the year. Same with Perkins loans. They're no longer available, but I still see them floating around a lot for veterinarians, health profession student loans, loans for disadvantaged students. I still routinely see people who leave out health profession student loans or loans for disadvantaged students outside of a consolidation loan. So maybe you heard some similar climbing Mount debt presentation when you were a student, and you'll remember that I told you to consolidate after you graduate. A lot of people do that, but they still may leave these outside of that consolidation, right? And it's because they're a little bit challenging to get in, and it's not as automatic as consolidating your other loans. But if you have these loan types and you're likely to reach forgiveness, or you're going to shoot for public service loan forgiveness, then this is the time to consolidate those loans into a direct consolidation loan, right? Even if it means including the rest of your loans in with it. Right. So those are some of the types of things we're looking for when we consider consolidation, but we'll get into that in a little bit more detail later on. So that just the detail of the dates, the pandemic forbearance benefits are over. They ended at the end of August. Interest turned back on September 1st, and payments resumed in October. So if you had loans that were in repayment and that payment was greater than zero, then you've made a payment towards your loans already, right? Since it's November, maybe even 2 payments. Right. So, and if it's been a while since you looked or logged in, then you should really log into at least your loan servicer account and see what it shows. You do get forgiveness credit for that forbearance time as long as your loans were not in an in-school deferment status. Right. So everybody, no matter what repayment plan they were using, gets forgiveness credit for the pandemic forbearance time as long as their student loans weren't in an in-school deferment. And that may have been true for some of you, particularly those of you doing academic residencies, if you were enrolled at least half time in some kind of master's program, which a lot of those academic residencies have alongside with them. Private loans are going to be pretty much anything that doesn't fall into this list, right? They're going to be loans with a bank name, Discover or Wells Fargo or Sallie Mae, Bank of America, those types of things. If you've lost track of any of those loans, you can review your credit report. This is a good habit to get into. So annualcreditreport.com, you can check all of your open lines of credit across all of the major reporting entities and see if there's anything that you've lost track of, or if there's anything negative on there, or things that you don't recognize, right? So at least once a year, maybe when you're filing your tax return, or maybe if you're using an income-driven plan, when you're renewing your income for that income-driven plan, check your credit report just to make sure everything on there looks as it should for you. We can examine this even further, the federal student loans. So once we kind of know generally what loan types we're dealing with, right, we can go over to studentaid.gov, grab our student aid data file, right? So which is kind of the ugly, hairy details of your entire borrowing history in a TXT file. We can take that file and then upload it into the VIN Foundation My Student Loans tool. Right? So I'm going to come over to the studentaid.gov universe and just make sure that everybody knows how to find this. All right, so I'm going to log in. Right, and this is going to be, you guys get to see how much student debt I have left. So this is usually pretty fast. Let's make sure that this comes through. All right, there it is. And again, I'd really encourage you guys to play along, right? I mean, this really helps to see your student loans and know if you need to act, particularly before the end of the year, or change your repayment plan, or you notice things that you want to ask questions about. So here, this is the dashboard in the student aid universe. I've got 173,000 of student loans. My interest has actually started creeping up again because the interest got turned back on. But this, again, this really isn't enough information for me to make any decisions. So I'm going to hit this view details, which is going to take me to this My Aid page. And I'm looking for this button here, this download My Aid data. All right, so when I click that, it's going to give me some scary language, but it's going to allow me to save this My Student Data TXT file to my device, right? So you're probably not going to be able to do this on your iPhone because it doesn't like to save files like that. But if you have access to a computer or something where you can download this file and save it to that device, then do that. And I'll show you what you can do with that in just a second. And so that's where we're going to then take that file and head over to the vinfoundation.org My Student Loans tool. So one of the handful of tools that are available in the VIN Foundation Student Debt Center, which is free for anybody to use, but it's designed specifically for veterinary students and veterinarians, right? So when you get to here, right, you're going to choose the one that matches you most closely. All of you guys are done with veterinary school, right? So you're going to upload your file here. I'm going to click this button. And I've got a handful of example ones that we'll use here today. Let's do this one here. So this tool is set up to take the data that's in that file and spit back at you the relevant information that you need to make some decisions, right? So we've got a summary of our loan types here. I can see I've got 6 all direct loans, which is great. I'm going to hit that loan types. I can see I've got all consolidated loans remaining, which means this person has already consolidated their loans, so they don't need to act to consolidate them again because they're already fully consolidated, right? So that's good news. And then I'm looking, and I've got another example I share with you, but I can see that this person didn't really have any breaks in their borrowing history, right? So 17, 18, 19, 20, 21, that's when they graduated, was in 2021, right? So there's probably not any additional repayment time here. But let's say this person, had a little bit of time before they went into veterinary school, and then they borrowed some loans from an undergrad education, and they finished that in 2014, right? So they might have had 3 years of payments on undergraduate loans before they started borrowing for veterinary school, that if they consolidated them all together, particularly before the end of this year, they would increase their overall forgiveness count by that 3 years, right? So that's kind of what we're looking for in that loan history right now, particularly to see if there's a reason for you to consolidate, right? I'm also looking for those federal family education loans or those Perkins loans that'll occasionally show up in here, right? If I see those, then I definitely want to consolidate my loans as well before the end of the year. I can also see my loan servicer. So if I forgot who that is, this is Nelnet, right? So I can log into my Nelnet account and see what my loan servicer is showing me. This particular file shows these loans to be in the pandemic forbearance, right? With a monthly payment of 0, right? So I don't know if this person has applied for an income-driven plan or their loans were just put into the pandemic forbearance benefit, right? So that's where I'm going to log into my Nelnet account. I'm going to see what they show me for a repayment plan. And if I don't see an income-driven plan, then I want to apply for one, right? Which one do I apply for? Well, now I'm going to check the income-driven repayment eligibility tab, right? And this is probably the most important tab on here, right? You could choose any repayment plan you want, right? But the income-driven plans have specific eligibility requirements, right? So I'm interested to know, am I eligible for pay-as-you-earn, the new SAVE plan? And then the big one is whether or not I'm eligible for the old version of IBR or the new version, right? It's an either-or thing. I'm either a new borrower, meaning I received my first loan after July 1st of 2014, and I'm a candidate for income-based repayment 2014, the new version, right? That's really important these days, right? Or if I don't meet that new borrower requirement, I'm eligible for the old version of IBR, which really has no utility anymore, right? The changes that have been implemented this fall have pretty much made the old version of IBR obsolete, right? So those are things I'm kind of looking for. Which repayment plans am I eligible for? Am I eligible for the new version of IBR or the old version of IBR? Which repayment plan am I using, right? If I saw IBR 2009 in here, I'm going to want to do something, right? Because I shouldn't be using that plan anymore. It's obsolete, particularly with the new SAVE plan, which is extremely beneficial, right? And we'll tie this all together when we get to kind of approaching repayment strategically, right? But there's an opportunity, particularly for those of you who have this combination where you're eligible for SAVE and you're eligible for the new version of IBR. You can use SAVE, particularly during your training while your income is low, so the Department of Education covers all of your interest for you, and then potentially switch to this newer version of IBR, which can allow you to reach forgiveness sooner if you don't end up paying your balance to 0 before you reach forgiveness, right? So those are the things that I'm primarily looking for, right? So those are the people that are kind of in the driver's seat, the people that have this combination, right? My loans are already fully consolidated. I'm 100% eligible for SAVE. I'm 100% eligible for the new version of IBR, right? I'm going to get my loans into SAVE for the duration of my training and put a pin in maybe switching to IBR 2014 down the road, right? Now, there's going to be a number of you that don't have this combination, right? So we're going to talk about what you should be looking to do next as well, right? But this is the one that is kind of like, I don't really need to do anything right now other than make sure my loans are in SAVE, and then I'll reevaluate once I finish my training in terms of potentially switching to the new version of IBR down the road. All right, so when we do assess our repayment options, we've got two primary categories that they fall into: time-driven and income-driven, right? So time-driven are pretty much traditional repayment options, right? So think of it like a mortgage or an auto loan or any other loan that you're probably ever going to have in your life going forward. We've got a principal, an interest, and an amount of time that we agree to pay back that loan, which is what determines that monthly payment, right? That's a time-driven repayment strategy. You could pay your federal student loans on a time-driven plan if you'd like. Private loans are only using time-driven repayment strategies, right? It's just a matter of how long that time frame is, right? And a lot of people want to pay their loans back aggressively, right? And I throw aggressive repayment strategies into the time-driven category, right? But they require resources, right? They require income, because depending on how much principal you have, right, the amount that you have to pay at least to extinguish that balance, let's say over a 10-year period, you know, if you've got $300,000 of student loans, is $3,300 a month, right? Now, most of you aren't even earning $3,300 a month as residents. So a 10-year plan isn't going to work while you're doing your training, right? And thankfully, you don't have to pay your student loans on a 10-year plan, but you might consider a 10-year strategy when you're done, if you're not going to hit forgiveness, right? And it's still, if it's a reasonable percentage of your after-tax income. And it might be, right? It really depends on which specialty you're pursuing and what you do after your training. But for many of you, it won't, right? So it really depends on what your student debt to income ratio is, not only now, but what it is when you finish your specialty training and you're earning a specialty income. And that's where the income-driven plans really come in handy, right? We can peg our student loan payment to a percentage of our income, right? And that will either pay that balance to zero, right? Because our balance is low enough and our income is high enough to pay that balance to zero, or we're going to hit forgiveness. We're going to hit the maximum time frame that we're allowed to make payments to those loans, which triggers forgiveness. And that time frame is a little bit different depending on the plan that you choose, right? And this is what this looked like a couple of months ago, right? So we just want to make sure that everybody's aware of the changes that have taken place. So revised pay as you earn has been converted to this new plan called Saving on a Valuable Education, right? So they renamed it, they changed some of the parameters of it, right? But SAVE used to be REPAYE, right? So if you were using REPAYE, which again, if you attended a Climbing Mount Debt session as a student, I talked a lot about using REPAYE, particularly during advanced training, like residencies, because of the unpaid interest subsidy. The Department of Education will actually cover a portion of your interest that your payment didn't cover. And one of the great changes with SAVE is they increased that unpaid interest subsidy. Right, so now if you're using SAVE, the Department of Education will cover 100% all of the unpaid interest that your payment does not cover. Right, so if you're accruing $1,000 a month of interest and your payment is $100 a month, right, you're getting a $900 a month subsidy. The Department of Education is making a $900 payment towards your loans, and your loan balance will not grow. Right, so SAVE is a amazing repayment option for those of you that are navigating advanced training. I wish I could say everybody should use it, right? And if you can, everybody should, right? But it may not always be the best strategy because of what plans you're eligible for and what you're doing beyond your training, right? But SAVE should be one of those ones that you're investigating during your training if you can have the Department of Education cover that interest while your income is lower. As part of those changes, they're also going to phase out a couple of the other repayment options, right? And a couple of you asked about this in your registration comments, right? So pay as you earn is going away, right? So it's going to be phased out for anybody who's not using it after July 1st of 2024. You can't get back into it, right? If you're using it now, or you sign up for it on June 30th, you can continue using it for as long as you'd like, right? But nobody's going to be able to get into it or get back into it after July 1st of 2024. ICR is also going to be phased out, but that plan really wasn't very beneficial for anyone. So that's not such a big deal that we're losing access to that one. This is also set up, and I've already introduced this previously, this opportunity for you to use SAVE during your training, but then switch to the new version of IBR so you can receive forgiveness sooner, because SAVE has a maximum repayment period of 25 years, right? 25 years is the total number of years that you have to have been in repayment before you're eligible for forgiveness. The new version of IBR has a 20-year maximum repayment period, right? So you trigger forgiveness after being in repayment for 20 years, right? So the strategy would be to use SAVE for at least your residency training and up to a maximum of 5 years, because there's a stipulation in the new rules that you can't switch into IBR 2014 if you have more than 5 years of payments using SAVE, right? But that gives you that opportunity to have SAVE and the unpaid interest while you're doing your advanced training, and then switch to that new version of IBR later on down the road if it makes sense for you to do so, right? So that's in a nutshell what has happened this fall with the repayment options. And as a result of the release of this new SAVE plan, the old version of IBR has become obsolete. Right, so that's another one of those things I'm looking for. I'm looking to see if people are using IBR 2009, whether they meant to or not. Some people just end up applying for quote IBR, and that's the plan that their loan servicer puts them in. But IBR 2009, particularly for anybody in an internship and residency, is not a plan you want to be in. Right, so SAVE is going to be a better choice always over IBR 2009. Where's public service loan forgiveness? Well, it's not actually a repayment plan, right? It's an additional benefit that you might be eligible for if you're doing all of the right things. And one of those right things is using an income-driven repayment plan, right? So public service loan forgiveness is an additional benefit on top of all of these other repayment options that you can be eligible for if you're making payments towards direct loans using an income-driven plan and working for an eligible employer, right? So public service loan forgiveness isn't a repayment plan, but it is a benefit that you can be eligible for if you're doing all of those other things correctly. All right, so let's dive into how they calculate your payments, right? And this is particularly relevant when we talk about what do I do with my student loans after I get that income bump, after I finish my training and I'm earning a specialist income. Right, so they use what's called a discretionary income, or a percentage of your discretionary income, and that has a very specific meaning or definition in the student loan repayment universe. And the discretionary income is your taxable income minus an allowance, right? Depending on the plan that you choose, the allowance is a little bit different, but your taxable income minus an allowance, and then we apply a percentage to that discretionary income based on the plan you choose. That determines your monthly payment on your student loans, right? So if you're using SAVE, and for anybody with graduate school student loans, the percentage is 10%, right? Your taxable income minus 225% of the federal poverty guidelines is your discretionary income. We take 10% of that discretionary income divided by 12. That's your minimum monthly payment for your student loans. Right, so the lower your income, the lower your payment, right? The higher your income, the higher the payment, right? And depending on the plan that you choose, that that payment can differ a little bit because of the way that they've tweaked the equation when they created SAVE, and even when they created Pay As You Earn in the new version of IBR. So if we've got $175,000 income after our training and we're using SAVE, right, 225% of the federal poverty guidelines, this is for a family size of one, 14,580. Our discretionary income is 142, 195. We take 10% of that divided by 12. Our minimum monthly payment is 1185 per month, right? And that's slightly less than it would be using Pay As You Earn or the new version of IBR, and it's a lot less than it is if you were to use the old version of IBR. Again, that's why that old version of IBR is pretty much obsolete at this point. How much should you pay towards your student loans? Well, the easiest way to approach that is to let your income determine the payment, right? We've got a pretty nifty formula here, right? So while I'm earning something in the residency universe, right, my payments are very low, right? When I finish that training and I get into my specialty income range, my payments go higher, right? But they're a percentage of my income, right? So theoretically, that should be manageable, right? Because my income goes up, my payments go up. My income goes down, my payments go down, right? So I don't have to worry about, how much should I pay, or just throw a magical number out there. I'm going to pay, $2,500 a month towards my student loans. Okay. Are you earning at least $330,000 a year, right? If you are, great. Then your income justifies a payment of $2,500 a month, right? But until or unless your payment, your income gets that high, you really shouldn't be paying $2,500 a month towards your student loans. There's better things you can be doing with that money until you do reach that level of income, and then your payment will adjust accordingly. And that's really what determines whether or not you're going to hit forgiveness, right? Is what your student loan balance is and what your income is. Right, your income determines that payment. That payment is applied to your student loan balance, and you've got a specified number of years to either hit zero, or you'll hit that maximum repayment period and the remainder of your student loan balance will be forgiven, right? Either is fine, right? There's really not a huge difference in cost savings if you take the approach of making payments as a percentage of your income until you either hit forgiveness or you pay the balance to zero, right? But there can be a significant difference in terms of the monthly payments and how much you end up paying compared to what you would have paid if you made payments as a percentage of your income and hit forgiveness, right? So that's where, we've spent a lot of time over the last 10 years crafting the VIN Foundation Student Debt Center and the loan repayment simulator. That's kind of the gem in that suite of tools. Helps you project whether or not you're likely to reach forgiveness based on your best guess of your current and future income layered on top of what your student loan details are, right? So that's going to be what determines whether or not you're likely to reach forgiveness. So
Tony, a couple of questions.
Yeah, go ahead.
Oh, sorry, I was gonna break in there while you had a moment. A couple of questions in the Q&A about those changes in the program. So first is, how long will interest be covered on SAVE?
The interest, so the interest subsidy will apply as long as your minimum monthly payment is less than the monthly interest accrual, right? So the higher your student loan balance, the higher your monthly interest is that accrues, which means the higher your income needs to be to generate a payment that exceeds that monthly interest accrual, right? So that I can illustrate this with an example, right? So in the file that I uploaded here, our person who has consolidated, right? This is really clean and easy because I see their principal. Interest is calculated based on the interest rate on that principal. $1,193 a month of interest accrues on this particular person's student loans. If they were using SAVE, if I come back to my prior slide, right, we need a payment that's above roughly $1,200 a month, right? So they would continue to receive that unpaid interest subsidy using SAVE until their income exceeds about $180,000 or $190,000 a year. Right? So it really depends on what your student debt balance is and what your income is in terms of how long you receive that subsidy. But some people will receive that subsidy for the duration of repayment because their minimum monthly payment will never exceed their monthly interest accrual, right? But for some of you, it will, right? So people who have a lower student loan balance, it doesn't take as much income to generate a payment that will cover that monthly interest, right? But so as long as that minimum monthly payment is below the monthly interest that accrues, you will receive that SAVE unpaid interest subsidy.
And then another question here regarding pay and save. Pay monthly payments are capped at the standard 10-year amount, but the save payments are not. Can you clarify on that?
Yeah, that's correct. So yeah, that is an absolute true statement, right? But so there's other differences to consider there, right? Particularly during your training, right? So pay as you earn doesn't provide an unpaid interest subsidy, right? The unpaid interest balance just continues to accrue, right? So your loan balance will grow. And if you hit an income level where the payment generated by your income is greater than what it would have been using a standard 10-year plan payment when you first entered repayment, they will cap that payment at the standard 10-year plan amount. And so that is a nice feature on pay, right? When your income, and generally that happens under pay as you earn when your income exceeds your student loan balance. It's actually it has to be a little bit higher than that. But when you hit a debt to income ratio less than 1, that's when you start to approach that level. Well, they'll cap your monthly payment at the standard 10-year plan amount. Right now, that's nice just because it keeps your student loan payment from being, it'll be less than 10% of your discretionary income at that point. Right now, SAVE doesn't have a cap. Right, the payment is always 10% of your discretionary income. Right, if you were earning $1 million a year, the payment would be 10% of your, something a little bit less than $1 million, your discretionary income. Right, it wouldn't cap it. Right, but if you're earning $1 million a year, who the hell cares? Right, I mean, it really, the pay as you earn cap is nice, right? But when if you're earning whatever it is that you're earning and your payment is 10% of whatever that number is, it really doesn't matter if it's capped or not. So and generally speaking, SAVE will result in a lower monthly payment than pay at the same income levels, right? So you're paying a little bit less usually using SAVE than you would be using pay, except when your debt to income ratio is much less than 1. Right? In those scenarios, you'll continue paying 10% of your discretionary income, which may accelerate your student loan repayment using a plan like SAVE compared to pay, which would then cap it at that standard 10-year plan amount. Right? And IBR does the same thing, right? So IBR 2014 has that same provision, right? Where it will cap your payment at that standard 10-year plan amount, right? Which is why you can use SAVE during your training, switch to IBR. It behaves just like pay, even if pay as you earn gets phased out. Right. So I mean, it's certainly a great point, and it's an interesting delineation between pay as you earn and SAVE, but those aren't things that I consider when we're looking at whether or not somebody should use SAVE over pay. Right. So, that's usually not one of the primary considerations. Right. But that is handled in the student loan repayment simulator. Right. So if that were to happen and you're comparing pay as you earn to SAVE, you'll see that play out. Right. If you have that scenario where your payment would be capped under pay, it'll cap it. Right. And it'll show you whether or not that results in forgiveness, or if it results in you paying more or less than you would using SAVE, right? So you can use that, and it's already accounted for within the VIN Foundation Student Loan Repayment Simulator. But again, generally speaking, I would say, I mean, if you're going to hit forgiveness using PAYE, you're probably going to hit forgiveness using SAVE too, whether you end up hitting that pay-as-you-earn cap or not. Right. So I wouldn't worry about that cap too much. The fact that PAYE has one and SAVE doesn't, right? It usually isn't one of those major deciding factors in which repayment plan to use. So when you do hit forgiveness, right, if you hit the maximum repayment period, you may have to pay a tax, right? And right now there isn't a tax due on any student loan forgiveness for anyone who receives it between 2021 and 2025, right? There's a special tax exemption that Congress passed back during the pandemic. It's due to expire after the 2025 tax year. At that point, we'll see whether or not they extend that tax exemption or they let it expire, right? So I generally encourage people to plan for the tax if it's going to happen outside of 2025, and then you can adjust accordingly if the tax exemption is extended. I generally don't recommend that residents worry about saving for any tax on forgiveness. You don't have the income, the cash flow to do that, right? So you can play catch up after you finish your training if the simulations that you're running are showing that you're likely to hit forgiveness and may have to pay a tax, right? So I wouldn't worry about that tax too much while you're completing your training, but then you can reevaluate that once you finish your specialty training and you know more about what your post training income looks like. Tax bomb. Is it a bomb? Yes, it's a big tax, right? But is in the grand scheme of what you're paying back in total, is it less or more than you would have paid if you tried to pay it back more aggressively? And for most people who hit student loan forgiveness, those who are projected to hit student loan forgiveness, their total repayment cost estimate is lower than they would have paid if they tried to pay it off and avoided the tax. Right. So I've come around to the fact that everybody calls it a tax bomb. I don't think it does it very good justice because it's something for people to avoid. And in reality, it acts like a huge discount. Right. I mean, if you think about what the top marginal tax bracket is in the US right now, it's 37%. Right. The worst case scenario is I'm paying 37% of what's left of my student loans, which means I just got a 63% discount. Right. That's the worst case scenario. Right now, there's a tax exemption in place. So if that were to get extended continually, I may not have to pay a tax, right? Which means there wouldn't be a bomb at all. It would just be gone, right? So somewhere in between those two is what's likely to happen, right? So I'm not, again, I'm likely, my wife and I are likely to hit forgiveness. I don't call it a tax bomb. That's going to be a huge discount, right? So yes, it's going to be a big payment we have to make to the IRS. But we're planning for that, right? So it's not like I'm, oh crap, I got to pay $125,000 to the IRS today, right? I mean, hopefully nobody would wake up and say that, right? You do have, 15, 20, 25 years to plan for that, which makes it much easier to work that into your overall finances and also helps to discount the amount that you end up paying towards your student loans even further. Right. So these are all things that you're going to have to work through. I can't necessarily answer for you. It really is going to depend on the specifics of your circumstances. Right. That's where we have to see those student loans. Right. We have to know what your loan portfolio looks like. How much forgiveness time do you have? Right. What is your income now? What is your income in the future? What does your family specifics look like? Are you married? How do you file your taxes? Do you live in a community property state? How many kids do you have? Right? All of these things play into this decision in terms of, am I likely to hit forgiveness? Am I not likely to hit forgiveness? Right? And there can be hundreds of thousands of dollars of difference on the table, right? So it's worth your time to take a look at it. right? So, you know, it's easy to just say, I'm going to avoid the tax bomb. I'm going to pay off my loans faster. Well, that means you're probably sacrificing other areas of your financial wellness and paying more than you otherwise would have to towards your student loans to do so, which generally isn't good finance, right? So we have limited resources. We want to do the best we can with those limited resources. How you pay back your student loans is a big part of that puzzle. And then there's public service loan forgiveness, right? So that's, you know, people ask, what's the fastest, cheapest way for me to get rid of my student loans? Public service loan forgiveness is the answer, right? Particularly for those of you that are doing advanced training at academic institutions, right? Because in my opinion, all of you should be receiving public service loan forgiveness credit for that time that you're doing internship, residency training at those academic institutions. And if you stay on with those institutions for, you know, 5-6 years thereafter, your loans are forgiven and you don't have to pay any tax on them. And you paid nearly nothing on them for the first 6 years, 6 to 7 years, right? So, you know, that's how it can play out. And if you really want to pay as little as possible towards your student loans, then public service loan forgiveness is for you, right? Now, there is, you know, there's some things that you have to be aware of there. It's only available for direct loans, which is why that student loan physical exam is so important, right? Are my loans all direct loans? If not, can I consolidate them to make them all direct loans? Which income-driven plan is going to work best for me? SAVE is going to be the best plan to use if you're on a public service loan forgiveness trajectory, right? And then the hardest part is am I meeting this work requirement, right? That essentially determines whether or not the payments that you're making are public service loan forgiveness eligible. They have relaxed these rules recently, right? So you have to be working an average of at least 30 hours per week with a nonprofit or a combination of nonprofits. But then you still have to make those 10 years of monthly payments. $0 payments qualify. The pandemic forbearance benefit time would qualify, right? If you were doing that training and meeting that work requirement there at an eligible institution during that time frame, right? So public service loan forgiveness is a huge opportunity, the holy grail really of student loan repayment for those of you that really want to get out from under your student debt as fast as possible and paying as little as possible, right? So it usually involves consolidating your student loans to make sure that all of your loans are in that direct loan universe. You've got the maximum amount of forgiveness time already logged, using SAVE because it's going to keep the payment as low as possible. If you're married, you're going to probably want to file your taxes separately, right? Unless your spouse is also working towards public service loan forgiveness or they have student debt as well, right? So it you know, that can depend, but you want to keep those payments as low as possible. You want to submit an employment certification form annually, right? You don't have to do that, but you don't want to get all the way to those 10 years of qualifying payments and then have to get all of that paperwork logged simultaneously, right? It's a lot easier if you're kind of logging that each year as you're renewing your income information on your income-driven plan to submit an employment certification form. So when you get that 120 monthly qualifying threshold, you can submit all of those employment certification forms with it, and you're likely to have your loans cancel a lot easier. I see some questions came in the chat. How does that work when we were not paying during COVID, but we were in residency? Yeah, so again, that COVID pandemic forbearance time, as long as your loans didn't get flipped into an in-school deferment status, right, which can happen during academic residencies, depending on, you know, whether or not you have some graduate school classes tied to that. The pandemic forbearance time is forgiveness eligible, right? And if you were checking the boxes, if you were meeting the requirements, the employment requirement here during the pandemic forbearance benefit, even though no payments were due, it's still public service loan forgiveness eligible, right? And then maybe that explains that, can I get payments retroactively applied to my public service loan forgiveness product? I saw at least 3 or 4 people ask some variation of this question during the registration for today. I'm not really quite sure I understand, but maybe, Margaret, with your question, it kind of makes sense. Maybe you guys are wondering if you can go back and get credit from the forbearance benefit for public service loan forgiveness if you were a resident at an academic institution or even an intern at that time at an academic institution? And the answer is yes, right? You can always go back, right? All the way back to 2007 when public service loan forgiveness was created. As long as you're meeting these requirements at the time, right? Now, the payments were suspended during the pandemic forbearance period, right? So no payments were due, but there's a special exemption on the payment part of it, right? If you were still meeting the 30 hours per week at a qualifying organization and you had all direct loans, then that time counts towards public service loan forgiveness, even though no payments were due. How do you begin applying for public service loan forgiveness? Right here, right? So public service loan forgiveness employment certification form, right? There's a page dedicated to it. You know, you guys will get access to this presentation as well, and these links will work within the presentation. But in the studentaid.gov universe, there's a whole bunch of information about public service loan forgiveness and how to submit an employment certification form. There's a paper form, there's now even an electronic form, right? So if you found your employer in the electronic form universe, it's a lot easier. Otherwise, you have to submit a public service loan forgiveness form, maybe a long form that somebody at your organization will sign off and say, yes, this person was working at least an average of 30 hours per week during the time frame they're asking for that public service loan forgiveness credit. So yeah, I would, I mean, because you never know where your career is going to take you, right? And this is, we see this a lot, right? So not only with interns and residents, but with, you know, practicing veterinarians who, because the majority of work as a veterinarian takes place in a private practice, right? So unlike the human healthcare field, veterinary medicine is primarily private for-profit practice, right? But a lot of veterinarians start in private for-profit practice and then make their way back into some nonprofit capacity, right? In which case they're now eligible for public service loan forgiveness. It didn't make any sense for them to try to accelerate their student loan repayment because now they can have it forgiven tax-free. Now, you guys are in a different universe, right? The majority, I would say, of the specialty folks are kind of headed on a public service loan forgiveness track, right? Because your majority of your training takes place in nonprofits. A lot of your post-training opportunities exist in academia, which are nonprofits, right? So there's a let's say straighter path, if you will, for those who are doing specialty training to reach public service loan forgiveness than maybe it is for general practitioners, right? So I would encourage everyone who's doing academic training to get that time logged as public service loan forgiveness eligible, just in case, right? Just in case you find some magical opportunity to, you know, go back to that same institution or another institution that is public service loan forgiveness eligible, and you'll have those loans forgiven sooner rather than later. All right, so let's skip that for now. Keep going. But just to kind of illustrate that this is working, right? Public service loan forgiveness doesn't get a lot of positive press, right? But it's happening. And a lot of corrections that have been made over the years, our colleagues are receiving this, right? It's becoming easier and easier. I'm seeing more and more residents provide student aid data files that actually have some public service loan forgiveness credit in them. That was hard to do before. Right, so this is becoming something that is more regular, and it's much easier to get that public service loan forgiveness credit than it has been in the past, right? So don't assume that you can't get it because maybe somebody else didn't get it, right? So apply for it, and even if you're rejected, find out why and see if you can fix those things so you can get that public service loan forgiveness credit. Okay, so this is the real big one, right? This kind of overlaps with public service loan forgiveness, but this is its own special benefit program that is time sensitive, right? So this is what's called the one-time forgiveness count adjustment, right? And it was announced a couple of years ago. It expires at the end of this year, so 6 weeks from now, right? So we're kind of in crunch time, and I'm seeing all the procrastinators kind of come out of the woodwork, right? So any prior repayment time and certain forbearance and deferment time is forgiveness eligible. No matter what you did with your student loans after veterinary school or before veterinary school, if you had loans from before veterinary school, if you didn't remember to include your health profession student loans or Perkins loans in your consolidation after you graduated, this is the time machine, right? If you consolidate your loans before the end of this year, and you have those loans that aren't eligible, right? You have you have non-direct loans, you have health profession student loans, loans for disadvantaged students, Perkins loans, those federal family education loans. If you have loans with differing amount of repayment time, right? So that example that I gave before where, maybe there was a 3 or 5 year gap between my undergrad and my veterinary school education, where I had some repayment time on those loans, and I've got different clocks essentially running on my loans. If I consolidate them all together, my new consolidation loan will assume the repayment time for the oldest loan in my portfolio, right? The one that has the greatest amount of repayment time, right? So I can jumpstart, in many cases, for those of you that have been doing advanced training because you graduated during the pandemic forbearance period, right? If you had some loans from before veterinary school, you could end up adding forgiveness time to your consolidation loan before you've even really made a payment to your loans, right? Which you're fast forwarding then to forgiveness, which is going to save you time and gobs of money on repayment. Right. So this is I mean, the giving out the forgiveness time like candy thing, this is crazy beneficial, right? But it does require you to act if you don't already have fully consolidated loans. Could you remind how to check if our loans are consolidated? Yes. So first step is going into that studentaid.gov universe and getting your student aid data file, right? So you're logging in studentaid.gov, looking for that download my aid data file. You're coming over to the VIN Foundation My Student Loans tool. You're going to take that file and upload it into the VIN Foundation Student Loans tool. Right now, there's just too many variations in terms of people's history, their loan borrowing history with the Department of Education. Right, we really need to see that file. I can't make sense of your loans just by how you describe them. Right, we really need to see them because everybody describes them differently, and the loan servicers describe them differently, and it just, the student aid data file has the answer in it. Right, so you have to go grab that student aid data file and upload it in here. Right, I'll use a different one here, and this one actually, I think I use this one to kind of illustrate some differences in consolidation and things that are kind of common, right? So this is somebody who graduated in 2022, I believe, or actually they might have graduated in 2023 and consolidated their loans, but they tried to consolidate, but they didn't get them all consolidated, right? Now, consolidation can be tricky depending on when you do it and whether or not your loans are in the right status, but this person got some of their loans consolidated, other loans were not consolidated. Right, so it was a partial consolidation, right? So it's a little bit messy. Now these loans have a little bit different repayment time because of how this loan ended up getting consolidated. This person actually can take a second bite at this apple, right? They can consolidate this consolidation loan with the loans that didn't get consolidated. All of these loans would end up on the same repayment schedule, right? So it wouldn't be messy, right? So I'm looking at the loan types here. I'd like to see 1 or 2 loans left and they only say direct consolidated are the types, right? But if I see consolidated, but I also see other types that aren't consolidated, that kind of raises that eyebrow. It's like, can I benefit from a consolidation, right? Now, not everybody needs to, right? But if you do have kind of this kind of mess, or let's say this person had a health profession student loan that they also forgot to consolidate, which again, for whatever reason is really common with those of you that do residencies, right? So when you provide your files and you provide your signament form, those health profession student loans don't show up in your student aid data file, so you have to add them separately, like I just did there, right? But in your signament form, you'll tell me, well, I've got $10,000, $20,000, $30,000 in health profession student loans, and I've got these direct loans too, and I didn't consolidate them. Right. I don't know why that is. I mean, we recommend that you consolidate all of them, because then it's easier to work with them when it comes to public service loan forgiveness, when it comes to student loan repayment. Even though those health profession student loans, you can defer them during your training and they don't charge you any interest, they're a mess later on, right? And it's easier to put them all into the consolidation loan. So this is an opportunity for you to do that, right? So I'm looking at these loan types, right? Which loan types do I have? If the 100% of them aren't already in the consolidation thing, then you might have some work to do, right? That doesn't automatically mean you have to. It just means you might have some work to do, right? And that's where it depends on what those loan types are, and which, and if you have any other ones to add, and particularly if you have other repayment time to gain. So let me show you one. I've got another example that'll illustrate that repayment time. This is actually another very recent graduate that we did a what we call a physical exam and treatment plan analysis for recently, and it just kind of shows a nice clear break between their borrowing history that I'm particularly looking for when I'm telling people to run to consolidate their loans. Right. So this is another example. This is somebody who actually just started an internship, but they have this one just jumps out to me, right? So in the loan groups, I'm going to hit the show details because it's going to show all of the loans. I can see I've got 22 different direct loans in this portfolio. Borrowing for higher education is messy, right? And it's messier for some than others, right? I'm going to sort this by the loan date, right? So I'm going through here. I can see that we've already paid off some of these older loans, and I'm like, oh, darn it. Well, I found one here, right? I've got one loan from 2017 that's still got a balance left, right? And they started vet school in 2020, right? So they have at least 2 years of additional forgiveness time, because there's a big break here between when they finished undergrad and when they started borrowing for veterinary school. That additional 2 years can be added to their direct consolidation loan forgiveness time before they've even started making any payments, right? So they've already fast forwarded therefore to 2 years towards forgiveness without having to make any payments. Hugely beneficial. For any of you that have found that in your portfolios, right, you're going to fast forward even more than that, right? Because you've already gotten nearly 4 years of forgiveness credit during the pandemic forbearance benefit, right? So if you got another 2 years here, that person would have 6 years of forgiveness credit before they've even really made a payment to their student loans. Right? So the closer you can get to forgiveness, the sooner you'll be done with repayment, and the less you're going to pay. I mean, it is really hard to overstate how valuable forgiveness time is, right? So if you find anything that's, worth a year or more, consolidate, run to consolidate, right? Because again, you have to do that before the end of this year to receive that one-time forgiveness count adjustment, that special treatment of how they will take the loan with the maximum amount of repayment time and apply that to the new consolidation loan when they give you the forgiveness count. Good question here. Is consolidation to fast forward forgiveness time beneficial if we anticipate never reaching forgiveness in the first place? Yeah, I can't tell you how many people think that they won't reach forgiveness, but will. It's just one of those things that, don't assume that forgiveness won't benefit you. Right. And if you don't end up hitting forgiveness, congratulations. Right. But most of the people who say that to me, I can run a simulation that will show you reaching forgiveness. Right. So you don't discount. It's better to have that forgiveness time and not need it than to not be able to get it later on when you do need it. Right. So that's just kind of those, there's just after doing this for more than a decade, life is messier than you can imagine. Right. And you never know what's going to happen and when you're going to need a little bit of financial assistance. And you'll find a lot of it in your student loan repayment benefits, even when you don't or didn't expect to receive it, right? So better to have that in your pocket and not need it than to assume you don't need it and then find out that you do need it later.
I
Are there
do think that's
drawbacks?
the benefit as well about using these tools and running the simulations like Tony is showing, because it's hard to understand that concept and how it might apply to your student loans. But once you actually start like putting those numbers to it, like Tony was just saying, it is kind of startling to see how many people will actually reach student loan forgiveness, even with, a higher income after you finish your residency training and everything else.
Yeah, absolutely. I mean, you really don't know. And I think people assume too, when you finish your training and you take that first job, that your income is always going to be that level or increase consistently thereafter. And sorry to break it to you, but that's generally just not how it works, right? So, there are going to be times when, and particularly in the veterinary industry, where a lot of your pay is determined based on your production, right? I mean, if you need to take time off for any reason, your income is likely to decrease, right? So it's just kind of, facts that we contend with, right? So until you put those numbers in the simulator and until you actually come up across one of those instances where you do see your income decrease for some reason, some expected, some unexpected, right? You'll find out how beneficial some of these things are. Are there drawbacks to consolidating a Perkins loans? No, there are none. So consolidate them, right? If you only had Perkins loans or your Perkins loans were kind of the majority of your balance, then maybe there would be consideration for it, but not for a veterinarian, right? So veterinarians, you're going to be better off with those Perkins loans in a direct consolidation loan than left alone. Same with health profession student loans and loans for disadvantaged students. So in the overwhelming majority of cases, those direct loans are going to be more beneficial than those other federal loan types. Is there any disadvantage at all to consolidating your loans, even if they are all direct? Oh, that one's too general. I really need to see your loan portfolio there to make that call, right? This person has all direct loans, right? And there would be a significant advantage to them consolidating. Now let's take away the 2-year at least repayment time that this person likely has on their loans. Let's say it's all consistent. Or if I go back to my previous example, right? This person only had loans from veterinary school and there was no break in it, right? And they're already well removed from their grace period, right? They're in repayment. All their loans are direct loans. They all are eligible. If there's nothing for you to gain from consolidating, then don't consolidate, right? And it's not that it would be bad if you did. There's just an administrative component that you won't have to deal with. Right? If you can gain 6 months, 1 year, 2 years, 3 years, 10 years of forgiveness time by consolidating, it's well worth your time to consolidate. Right? But if you're not going to gain anything from it, then don't waste your time. Right? But what I'm saying is more people than not seem to be able to gain something by consolidating than those who won't. Right? But we do find those too, right? But it really depends on the specifics of your circumstance. And when you're in your residency, you're going to want to make sure that this consolidation completes appropriately, right? So it's a little bit of an administrative burden. So there's some time on your hands, particularly if it doesn't go right, then you have to correct it, which can be difficult, right? But it's worth doing that if you can gain either adding loans to it that otherwise wouldn't be eligible, or if you can add forgiveness time to your overall portfolio. Oh, another good question from Lauren. Would a break during vet school when loan payments were made count towards forgiveness time? It depends. It depends on how big the break was, right? So I have seen a number of veterinarians who had a year break during vet school, but their loans were still in an in-school deferment status. Even if you made payments, if your loans weren't actually in repayment, then it wouldn't count towards forgiveness, right? So you would have actually had to have been kind of kicked out of that in-school deferment status and your loans officially have entered repayment and you had a minimum monthly payment officially due on your loans, right? If that was the case, then you would have some repayment time in your loans, right? But that's one that where I would encourage you to fill out a student debt and income signalment form through VIN Foundation, and we can kind of pick through that with you and help you make that determination. Yeah, and that kind of relates to the anonymous question too. Is it possible to schedule a meeting with you to evaluate an individual's loan portfolio? That's how we do that, right? So we provide that assistance through the student debt message board area, right? And when you're logged in using your VIN or VIN Foundation username and password, as you can see that I am here, you'll have a link to the student debt message board area, right? And I'll kind of use this as an opportunity to show you what that looks like. Right, but when you fill out a student debt and income signalment form, which will include your student aid data file, right, you're going to see, we'll take that form. This is kind of what the form looks like in the message boards, and we'll post it anonymously to the message boards, right? So this is what the form looks like on the message boards. And behind this is the student aid data file associated with it, right? So we have this person's student aid data file. We have all of the debt and income and family information specifics that we need to pick through that student loan history, do that physical exam, and come up with a treatment plan for them, right? And that's what we do here in the message boards, and we do that anonymously. So Becca and I know who you are, but the rest of the VIN community doesn't, right? So you get the answers that you need, but the rest of the community gets the benefit from the overall experience, right? So it's kind of how this is secret sauce for how VIN works. And we just applied that to student loan repayment, right? So we have that VIN Foundation student debt help page, vinfoundation.org. And then under the programs, student debt help. Right, and there's a link to this on the presentation as well, but since I've seen a couple of you ask about it, this is what this looks like, right? And this infographic kind of walks you through the same process, right? Log into the Student Debt Center, download your student aid file, upload your student aid file, fill out the signalment form, right? The signalment form is what allows us to officially work on your student loans, if you will, right? Because then we know we've got all of the information that we need to actually give you the answers that you're looking for. All right, so I do have in here, and maybe some of this will help to answer these questions. So consolidate if you have non-direct loans. So health profession student loans, loans for disadvantaged students, Perkins loans, those older Pell program loans. As long as they're not like 1% of your portfolio, it's probably worth consolidating them, right? So, you can draw a line somewhere. I'm not sure exactly where that is. It really depends on what your plans are, right? So if you're gonna shoot for public service loan forgiveness, then consolidate as many of those loans as you can so they're all eligible for public service loan forgiveness, right? Because these other loans aren't eligible for public service loan forgiveness, right? They have to be direct loans. And this is a unique opportunity to turn them into direct loans, even if you didn't after veterinary school. If you have loans with differing amounts of forgiveness time, like I illustrated before, right? This last one is kind of very new grad specific, but some of you may be able to relate to this, right? So if you start one of those PhD residency programs before your student loan grace period ends, you could have your loans end up stuck in an in-school deferment for the duration of that PhD program, which I've seen happen too many times and they're heart-wrenching, right? And there's no way to get your loans out of that in-school status because that previous grace period hasn't expired until you leave that program, right? So either you finish it or you take time off from it, right? So that is one of those situations where we really try to get that information to the students so they can consolidate their loans after they graduate and their grace period before they start that PhD residency program, right? Those are really problematic, but there's so few of them too. It's really hard to find those folks before they actually start them. But these are some guidelines that you can use in terms of consolidating your loans, whether or not you need to, based on what you're finding on your student loan physical exam. All right, deferment and forbearance. This is why it doesn't make any sense, right? So deferment and forbearance, again, still kind of this reflex built into the medical advanced training community that I defer my student loans or I forbear my student loans during this advanced training. That is no longer a good idea. That interest will accrue. You won't get any forgiveness credit for it. And when you're done with that training, they're going to take your interest and they're going to add it to your principal, which means you're going to accrue more interest while you're paying back those loans. So whether you end up hitting forgiveness or you end up paying the balance to zero, you're going to end up paying more than you had to, right? So deferment and forbearance is a no-no, right? Colleagues don't let other colleagues defer their student loans, right? Applies to forbearance as well. The pandemic forbearance was a completely different story, right? Because the traditional things that happened during a deferment and forbearance were also suspended during the pandemic forbearance, right? So they gave you forgiveness credit for it. We weren't accruing interest, so it wasn't a bad thing to not make payments during the pandemic forbearance benefit period, right? But now we're outside of that, right? We're back to, or almost back to, something that resembles normal for student loan repayment, which means there is not a good reason for anybody to ever defer or forbear their loans, right? So you really have to try to make sure that that doesn't happen. And this applies to not only internships or residencies, but after you're done and maybe you go on maternity or paternity leave, or you take a family leave to take care of a sick relative, or you're changing jobs, or you lose your job or whatever, right? The loan servicers will push you into forbearance, right? Because it's quick and easy, right? But instead, if you have no income, resubmit to have your payment calculated to reflect your lower income status, right? You'll still get forgiveness credit. You'll prevent that unpaid interest from growing in some cases if you're using SAVE, and it won't get added to your principal, right? So stick with those income-driven repayment plans rather than defer or forbear. What if your loans have been placed in administrative forbearance to the loan servicer? That's okay, right? Mine are currently in administrative forbearance because they screwed up my payment when they switched me from REPAYE to SAVE. Administrative forbearance is for them to clean up their mess, right? And you still get credit for that time, or you should get credit for that time, right? That shouldn't penalize you, and you shouldn't see your unpaid interest capitalized unless you're switching from old version of IBR to, or you're switching from IBR to SAVE or something like that. But administrative forbearance shouldn't penalize you, right? So it's usually just time that they take to clean up some of the things that either are screwed up or taking longer than they should, right? Which is everything right now if you've had to deal with any of the loan servicers. All right, so for specialty training, I would say rather than a deferment or forbearance, SAVE is best, but isn't always the obvious one, right? I would love to just say everybody get their loans at the SAVE, but it really depends on your repayment options that you're eligible for, particularly for those of you that are not eligible for IBR 2014 and are projected to reach forgiveness. That's a tough one, right? So if you can use SAVE, use it. If not, then probably pay as you earn is your next best bet during advanced training. For those of you that are doing academic residencies or PhDs where you're enrolled at least half time, the entire higher education system is plugged into the Department of Education. They know that, and the system is set up to automatically defer your loans. Right now, you can decline that deferment as long as those loans that they're deferring have already been through their grace period and are otherwise in repayment. Right, you can decline that deferment. Right, so if you know that you're enrolled in these classes and you're considered to be at least half time, then you have to call your loan servicer and tell them to ignore those deferments. Otherwise, they will keep deferring your loans. And this happened to my wife during her residency, right? So they knocked her out of IBR at the time and put her loans into an in-school deferment, which doesn't count towards forgiveness, and capitalized her unpaid interest. So we learned the hard way. right? So you have to call them ahead of time and say, I do not want you to defer my loans, keep them in repayment, right? And that way you'll keep logging time towards forgiveness and you'll prevent that unpaid interest from capitalizing. All right, income. I saw some questions too about in the registration concerns about renewal dates, right? When do I have to renew my income again, right? That's going to be in your student aid data file, right? Nobody was required to provide income information during the pandemic forbearance period and for 6 months after that ended. Right, so nobody has been required unless you have a circumstance where you can decrease your payment, you can choose to renew your income, but nobody has had to do their annual income renewal since the pandemic forbearance benefit started and 6 months after. Right, so if you see a anniversary date that's before March of 2024, you can keep adding a year to it until you get beyond March of 2024. Right, so if I look at some of these files, so this is a person that's using pay as you earn, has an anniversary date of November, like from 11 days from now, 2023. That's not correct, right? Because the pandemic forbearance, the end of the pandemic forbearance said, we're not going to make anybody renew for at least another 6 months, right? And the language also says, if you see an anniversary date that falls within that time frame, you can add a year to it. Right, so this person will have a $0 payment using pay as you earn until November of 2024, right? And sometime around August or September of next year, they'll have to provide updated income information to have that payment recalculated. Right, now they may want to choose to switch to save at that point, right? Because this person is eligible for the new version of IBR, right? So this is a person who, if I were looking at this and I wasn't able to get a payment that is zero or very close to it by switching to save, I would wait until next November, until I'm next due to renew, and then I would switch my plan to save, right? So I can preserve that $0 payment, right? But if I could get a payment that's zero or very close to it by switching to save now, I would just apply to switch to save now. Anniversary dates are going to come up later too, because they're really important for how we handle your income bump after you finish your training, right? Because I think everybody thinks that, all right, I finished my residency, I'm no longer earning $50,000 a year, I'm earning $200,000 a year, I have to tell the Department of Education. And it doesn't work like that, right? Your payments are set for year-long schedules at a time, right? And unless something happens where your income decreases, they don't want to hear from you, right? So they actually won't change your payment if it will go up unless you're due to renew. But if your income goes down for any reason and you're not yet due to renew, they will recalculate your payment, right? So you have time for your student loan payments to catch up even after you finish your training. All right, so just quickly, we're going to cover some of these, this is some of the nitty gritty save, the changes that came online. One of the big changes from REPAYE to save was that they now allow you to exclude your spouse's income if you file your taxes separately. REPAYE didn't allow that, save does, right? So that's what makes IBR 2009 obsolete. Before save came about, we had people that were stuck using IBR 2009 because they were married and it made sense for them to file separately, and they couldn't do that with REPAYE. They don't have to worry about that anymore, right? So they could move over to save and still file their taxes separately and have their payment based on only their income. We also had this switch thing put into place. This is something to be aware of, right? So if you want to, or it looks like you're going to hit forgiveness and you're eligible for IBR 2014, but you want to use save for the unpaid interest subsidy, You can't log more than 60 payments with Save and still be able to switch to IBR. Excuse me. So if you're going to employ that strategy, you kind of have to set some calendar reminders for yourself, right? So the soonest this is going to actually trigger that, where that 60-month, that 5-year threshold pertains, is July 1st of 2029. So anybody that's using Save now or thinks they want to use Save and then switch to IBR 2014 later, set a calendar reminder for, January 1st of 2029 and check in to see if it still makes sense for you to switch. It may or may not, right? So it really just depends on what your circumstances are at that time, but you want to make sure you don't miss that window, right? That's going to be something we'll talk about, in a few years, a lot more, but right now it's just something to be aware of. The phase out we already talked about. So let's kind of dive into some of these, the strategies and how you can approach repayment, not only during the rest of your training, but after that. This was, I thought, a perfect lead-in, right? So somebody asked, I want to learn about different options to pay off loans quickest, right? The best is not always the fastest is not always the cheapest, right? It really gives me an opportunity to kind of, repeat that. It's really counterintuitive when it comes to student loans, but there's really not a lot of good reason for you to try to pay off your student loans faster than your income requires. Right, you're going to usually end up paying more than you have to, and in most cases, those people are also going to end up sacrificing other more critical elements of their financial wellness for something that really doesn't provide all that much benefit. Right, hitting zero on your student loan balance quick might be a personal goal, but it really doesn't necessarily do anything other than hurrah, right? So I would really make sure that the rest of your financial wellness is adequately taken care of before you go the hurrah route, right? And in a lot of cases, and again, kind of as Rebecca said before, it's amazing how many of these simulations turn out with people hitting forgiveness and being less than they would have paid using an aggressive repayment strategy, right? So that's where that comes from. And, it also, I still, people have a hard time answering this question, but I ask it anyway. Right? What happens if you don't pay your student loans fast enough? Right? And the answer is nothing. Right? There's nothing that happens. I mean, whether you pay your loans in 7 years, 10 years, 12 years, 20 years, 25 years, it really doesn't matter. Right? It's what you do with all the rest of the earnings you have that does matter. Right? Your student loans are going to go away one way or another. Right? You're either going to earn enough to justify a high enough payment to pay the balance to zero, or you're going to hit forgiveness. Right? Either results in a $0 payment. Right? So in my opinion, the best strategy is to take a measured approach, pay the percentage that the income-driven plans require, and you'll either hit forgiveness or you'll hit zero. Right? It not only takes some of the stress out of student loan repayment, but it also reduces the risk to myself and my family, and it maximizes my monthly cash flow. It allows me to decide where the majority of my money goes, as opposed to predetermining that it has to go towards my student loans. Right? And this is probably the biggest benefit, reducing the risk to myself and my family. If something should happen to me, my student loans are not going to be the responsibility of my spouse or my child. Right? They go away with me. Right? So I see a lot of people that want to pay their loans back quickly because they want to make that not be a burden for their family. It never will be. Right? So again, you're either going to pay the balance to zero, you're going to hit forgiveness, or they're going to go away. Right? So nobody else is ever going to be responsible for paying them. All right. I'm going to kind of just fast forward through this really quickly because it illustrates the forgiveness planning portion of it, right? So this is what my forgiveness plan looks like, right? So I pay the minimum and plan for the tax that both my wife and I are likely to reach, right? We have combined in excess of $400,000 of student debt, right? So this is our forgiveness savings plan, the majority of it, right? So the dotted line represents what we've contributed. The solid line is the value of this forgiveness fund. Right now, I don't have to contribute to this anymore. right? The dividends that are distributed automatically get reinvested is enough to cover what my projected tax target will be roughly 14 years from now, right? So I don't need to change that. And if there's no tax on the end that I have to pay, then I've got a bonus fund that we could use for other areas of our financial wellness at that time, right? Or if I see, 5, 10 years from now, Congress increases federal income tax rates, well, then maybe I want to contribute a little bit more there just to make sure that I'm covered, right? But the goal is to get this started sooner rather than later so time can be your friend, right? And the bigger this gap between what you contribute to what the value of the fund is savings towards your student loan payment, right? I'm using the power of compound interest here to pay for a good chunk of that tax, which further lowers the amount that I pay towards my student loans if I have to pay the tax. Right. So this is just really important. And the people that start these forgiveness savings plans sooner have a much easier path to navigating some of the changes that we've seen recently, particularly the should I use PAYE? Should I use IBR 2014? Because the forgiveness happens sooner, the tax amount can be higher. The people that have started these forgiveness plans sooner have more flexibility to make that decision. Whereas the people that have waited 15 years to start their forgiveness savings plan and they're knocking on the door of forgiveness, they're probably going to want to use SAVE because it's going to extend repayment for another 5 years, which gives them some time to actually have a tax planning fund in case they need it. Right. So again, I'm not implying that you guys need to start this while you're doing your training, but it should be on your radar soon thereafter if you're projected to reach forgiveness. Right. So that's where, we know from using the foundation tools that we're likely to hit forgiveness. Who knows? Still could happen that it doesn't. It still might be that we don't, but chances are it will. Right. So we're going to plan as if we do have to pay that tax, and we're essentially over prepared. Right. We don't need to keep saving anymore, and that fund will continue to grow and plan itself for us for our potential forgiveness tax down the road. When it comes to applying this to your own circumstances, your debt to income ratio is a huge component of that, right? When your student debt to income ratio is less than 1 at graduation, right, you're likely to pay your balance to 0 before you hit forgiveness. If your student debt to income ratio is less than 1 at the time you complete your specialty training, you probably won't hit forgiveness, but it's still possible. It really depends on how much forgiveness time you already have, right? And with the one-time forgiveness count adjustment, you may have more than you realize, right? So I would really look into that, right? But there's a good chance that you will. If your debt to income ratio is less than 1, as soon as you finish your specialty training, right, and you went kind of the internship 3-year residency specialist route, right, then you're likely to pay the balance to 0, right? But I also see a lot of folks with 1, 2, 3 internships, then a residency, right? You're going to have more forgiveness time than somebody who's kind of gone that straight line approach, right? So it really depends on your pathway to and through that training to determine whether or not you're likely to reach forgiveness. If your debt to income ratio is greater than 2 at graduation, right, you're likely to hit forgiveness. If your debt to income ratio is greater than 1 after your specialty training, you're still likely to hit forgiveness, right? So these are just generalities, right? After running thousands and thousands of simulations for any scenario you can possibly envision in veterinary medicine, these are the themes that have arisen, right? Now you can test that for your own scenario and see, and if you'd like some assistance testing that too, that's where you can, participate in that student debt help. And we can walk through that with you on the message boards as well, right? But if it were my dog, right, if I had a debt to income ratio less than 1 after I finished my specialty training, I'm probably going to stick with SAVE or PAYE and just keep making the payment my income requires until I either hit 0 or I hit forgiveness, right? I'm not going to really worry about accelerating my student loan repayment because there's other better things that I think I could be doing with that money. Right? If my debt to income ratio is greater than 1, am I eligible for the new version of IBR? If I am, then I'm going to get my loans at the save stat, right? Because I want save and the unpaid interest subsidy to cover all of that interest that I'm accruing during my training that I won't have to pay when my income increases, and then maybe consider a switch to IBR 2014 down the road. If I'm not eligible for the new version of IBR, but I am eligible for pay as you earn, I really have to run those simulations to see, is there a clear delineation between using pay or using save? If the outcomes are about the same, then I'm probably going to use save because I'd rather not watch my unpaid interest balance grow. Right? And there's always that potential that I end up paying the balance to zero before I reach forgiveness, and that will prevent me from paying more than I have to, right? Because the save will cover that interest, right? But it's a tough one. That's what I call the pickle, right? The people that are going to lose access to pay after July 1st of 2024, right? Should they use it so they don't lose it? Right, but that means they're giving up save and the unpaid interest subsidy. This is the one part about the recent changes that really drives me nuts. I hate that they're forcing people to make that particular decision, right? Because it requires a crystal ball that nobody has, right? So the best you can do is use the information that you have available at the time and, take your best guess. And if you want some help with that decision, we can help you with that over on the message boards. If you're not eligible for pay as you earn, right, use save. Right, that's an easy one, right? IBR 2009 is obsolete. If you don't have access to pay as you earn or IBR 2014, then save is your best repayment option going forward. Don't refinance your student loans. It used to come up more often when interest rates were, next to nothing, but we don't live in that universe anymore. Right? And there's really no good reason for you to refinance your federal student loans with a private loan that's less flexible and is likely to have a higher interest rate than you guys have now, right? So there's really no value in refinancing your federal student loans into a private loan. All of this is really going to depend upon how much forgiveness time you have, right? And we can take a guess right now, looking at your student aid data file, right? But in 2024, we'll all get an official count. Right, so as part of the one-time forgiveness count adjustment, they're actually going to show us how much forgiveness time we have. And that's going to become part of the data that's in your student aid data file. Right, so we can show you that when you upload that file in the My Student Loans tool as soon as it is applied. Right, so we're expecting that count to be applied in 2024. Don't know exactly when. My guess is going to be probably later than earlier because it seems like they're kind of behind schedule on all the things that have already happened. So, but in 2024, we'll have a more definitive answer of how much forgiveness time we have, which means we'll know how much time we have before we hit forgiveness. So after your training, these are the things that I'm thinking about, right? What is your renewal date, right? Again, as soon as you finish your specialty training and you sign on to earn a specialist income, your student loan payment doesn't go up automatically. Right? It goes up the next time you're due to renew. And then when you renew, you're probably using a tax return from the past, right? Which is still a very low number. Right? So you're going to have quite a long ramp of when you complete your specialty training, you start earning a specialist income, and when your student loan payment actually increases commensurate to what that specialty income is. You're going to have at least 2 years of let's call it an artificially low student loan payment, which is awesome because it gives you a time to jumpstart your overall financial wellness, right? The longer it takes you to kind of get to a professional earning income, the further behind you are with other financial wellness items, retirement savings, emergency savings. If you want to buy a home someday or start a family, all of that stuff is postponed, right? Because you've been doing that training. So you have to play some catch up. And your student loans don't, right? There's really, again, not a lot of good reason to overfocus on your student loans. It's better to overfocus on all of those other things that I just mentioned to play catch up on rather than accelerating your student loan payment. So and that's where this lag time frame with how your payment is calculated comes into play, right? When am I next due to renew? When I do renew, I use the adjusted gross income, AGI, from my most recently filed tax return, right? So if I'm finishing my training in 2024, the most recent tax return I have on file is from 2023, which represents my residency year of earnings, right? So I'm still going to have another student loan payment that's based on that income, right? And then when I file that tax return the following year, I'm going to have income from my residency plus income from my specialty gig, which is still going to be lower than I'm currently earning, right? So I'm going to have a second year of artificially low monthly payments for my student loans, right? And if those payments are still below the interest that accrues and I'm using SAVE, the Department of Education is covering that interest, right? So my balance isn't changing. I'm just maintaining by making the minimum monthly payment, right? So I'm not any worse like I was before SAVE existed. I'm just making the minimum monthly payment required by my income from a year or a year and a half ago, so my interest doesn't accrue, and postponing that payment down the road while I can do other more valuable things with my cash flow. Right? So when I do consider whether or not I should make a more aggressive payment towards my student loans, I have to compare what would that aggressive payment be, right? So when most people say I want to pay my loans off quickly, right, they use very subjective terms. I'm going to pay them off fast, aggressively. I'm going to put a bunch of money towards my student loans. I'm going to accelerate my student loan payment. Well, what does that mean, right? I mean, you have to kind of define it. How many years do you think you want to take to hit zero? Because that's what's going to determine what that payment needs to be. You have to define that. You can't just kind of randomly throw a bunch of money towards your student loans. Who knows when you're going to pay it down, right? So if you want to set a 5 years from when I finish my training to pay off my student loans, all right, well, then we got to figure out what the monthly payment is going to be to contend with that, to make that happen. And then I'm going to compare that to what my income requires me to pay. And in most cases, you're going to find thousands of dollars of difference. And then it's up to you. Do you really want to pay thousands of dollars more towards your student loans when you could be using that for other more valuable items, right? Just to reach that 5-year time frame as opposed to a 10-year or 12-year or 15-year time frame, right? And that's where, it's up to you. Right, so this is kind of the mechanics of how this works, right? So let's say you finish your training in July of 2024 and your current residency salary is $50,000, which means your monthly payment using a plan like SAVE would be about $100 per month, right? So let's say you finish your training in July, you start your specialty gig on August 1st, right? When you're next due to renew on October 1st of 2024, right? My payment is going to be based on about $50,000 of income, right? Because that's what my tax return from 2023 filed in early 2024 is going to show, right? When I renew again in 2025, what's my adjusted gross income going to show? It's going to show half a year's worth of residency income and about 5 months of specialty income, right? So I'm going to have about $108,000 of income on that tax return that I'll use to renew my income in 2025. So my SAVE payment will be about $630 a month, right? Then when I renew in 2026, I'll have maybe my $200,000 specialty salary, which will generate a payment of $1,400 a month, because that's going to be what's showing on that most recent tax return that I filed for 2025 early in 2026. Right. So that's one of the reasons why these income-driven plans are so beneficial, right? Before I have something that even approaches an appreciably monthly student loan payment on my student loans, I've got at least 6 years of forgiveness time, right? And depending on what my student loan balance is, I'm likely to hit forgiveness under a plan like the new version of IBR if I'm eligible for it, or maybe even SAVE, right? And that's what will flow through the student loan repayment simulator when you're running those particular simulations. What is the latest date we can switch from save to pay? So if you want to use pay as you earn, you have to make sure you're in it before July 1st of 2024. So about what, 7 months from now, 7 or 8 months from now. Right. So that's pretty risky, right? If you want to play that, but you know, you're welcome to try. I saw a couple people in the registration ask about how your student loans or how to handle your student loans if you're married to somebody else who also has student loans, or if you're married in general, right? Does your spouse have student loans, right? If they do, then you may want to look at what each of your shares of the payments would be applied to your respective student loans by filing jointly, right? Now, if there's a big discrepancy in your incomes, it may make sense for you to file separately, right? It's really going to depend on what's going to keep the most money in your household budget, right? Generally speaking, all of the tax incentives favor filing jointly when you're married, right? So when you file separately, there'll be some, let's call it penalties, right? You're going to end up paying a little bit more in taxes. You're going to lose access to certain benefits that are only available to people who are married and filing jointly and not available to those filing separately. But if your student loan payments are otherwise lower by filing separately, and so low that you eclipse those extra costs by filing separately, then it still makes sense to do so. And that happens pretty frequently, right? Particularly for folks who are married to a spouse that don't have student loans. Right. So I would encourage you to look at that. You might have to visit with an accountant to help tease out what those costs are between filing separately and filing jointly from a tax standpoint, from a benefit standpoint. But then the student loan repayment simulator can help you work through how much do I stand to save by filing separately or excluding my spouse's income from the calculation. Right. But if you both have student loans, like this person was asking about, my husband is also a doctor and has large debt, should we continue filing separately? Well, I don't know if continuing to file separately, I'm not sure if separately made sense in the first place, right? When you both have, like both my wife and I both have student loans. Right now, technically speaking, if we filed separately, our overall combined student loan payments would be slightly lower than they are now. However, we would pay much more in taxes to do that, right? So it doesn't make sense for us to file separately. But because we both have student loans, it makes sense for us to file jointly. And in that case, my payment is otherwise lower towards my student loans than it would be if we filed separately, because my wife's student loans are a higher share of the overall household balance, right? So they factor all of this in, and those payments are applied proportionally to the respective loan balances. So oftentimes it does make sense for you to file jointly. And this person who says, my husband is a doctor who has large debt as well, the person who has the lower amount of debt in the household generally sees a lower payment than they otherwise would if your incomes are, relatively similar, right? So you may want to look into that tax filing difference and see, it might make sense for you to file jointly in that case rather than separately, to preserve those tax filing benefits as long as your student loan payment doesn't change too much. Community property states, so the big ones, California, Texas, mostly along the West Coast there, Wisconsin, Louisiana are kind of outliers. But if you live in one of those states and you file separately, generally they pool your incomes together, and then you get a tax return that has half that income. Your spouse gets an income that has, or a tax return that has half that income. You could use that too as income documentation for your monthly student loan payment, which may be much less than your income, right? So if you live in a community property state, you actually have another option of income documentation that could make an income-driven plan more beneficial than if you didn't live in a community property state. Okay, kind of winding down here. So top repayment mistakes I see, assuming an income-driven plan or public service loan forgiveness won't work for you, right? I I know it seems like you're probably going to pay your loans to zero, but don't discount it. Get that forgiveness time, get that public service loan forgiveness time just in case you need it. If you do need to consolidate, now's the time to do it, right? Before the end of this year, ideally, right? Please, please, please don't be that person that reaches out for help on January 1st and we have to say, this would have been a lot better if you did this yesterday, right? So give yourself, you've got a little bit of time here to look into that. Make sure you try to do that if it makes sense for you to do that. Choosing income-based repayment plans. I know colloquially that's what they're known as, but income-based repayment is a specific type of repayment plan that's probably not the one that you want to be in right now, right? So the ones that you want to be in right now are either save, pay as you earn, right? If you're not, if you're kind of in that pickle. Don't use forbearance, deferment, don't miss your renewal periods, right? Set up those calendar reminders. That sets off a chain of reaction of things that you do not want to try to undo. Paying more than your income requires, particularly while you're using save, right? That's kind of why I wanted to really go through that income ramp up thing with you guys specifically, right? There's a really good chance that you're still going to be receiving that save unpaid interest subsidy for 2 years after you finish your specialty training. Right? If you make extra payments towards your student loans while you're still receiving that subsidy, you're literally lighting that money on fire, right? Donate it to VIN Foundation instead, right? I mean, it doesn't make sense for you to pay that extra towards your student loans while you're receiving that unpaid interest subsidy. Putting student loans ahead of more critical financial wellness areas, right? That never makes sense, right? Even if, you're scheduled to pay a little bit more in student loan repayment, using an income-driven repayment plan, I'm betting you can outgrow that difference exponentially in something like tax advantage retirement savings, which we can all do a better job of boosting, right? So it really doesn't make sense for you to accelerate your student loan payment ahead of those other financial wellness items. And then switching away from an income-driven repayment plan or refinancing, especially if you're projected to reach forgiveness. All right, I'm going to kind of dive into these questions that are remaining here. So I see there's one, and I know you've been really patient on this one. An anonymous person asked, say you didn't know better and were in deferment. Is there any way to make retroactive qualifying payments to work towards forgiveness? I don't believe there is. So I think you're just going to have to end that deferment, apply for an income-driven repayment plan, and kind of write off that as a mistake, right? So you can ask. I don't believe that you're going to be able to get credit for that time. You may get lucky, right? Now, again, this is where the difference between the deferment and forbearance is going to be really important, right? If it was a forbearance and not a deferment, right? So if it was an in-school deferment, then there is no way, right? But if it's a forbearance and it was during the pandemic forbearance benefit period, or it's during this one-time forgiveness count adjustment period, you might get lucky and get credit for it, right? So again, in that case, count your lucky stars and don't make that mistake again, right? You kind of got a do-over card there, right? So that's kind of that time machine I was talking about. In regards to signing bonuses, for those offered a fairly substantial signing bonus, are there benefits to having the hiring hospital apply the signing bonus to loans? Absolutely not. Absolutely not, right? Those signing bonuses, you're going to have to pay taxes on those, right? If they're not already paying taxes, taking taxes out of them. Those signing bonuses are likely going to have strings attached to them, right? Meaning that if you don't satisfy a certain amount of time with that employer, they're going to try to come back for that signing bonus, some, if not all of it, right? And if it went all to your student loans and you have to leave that position for any reason and they want that amount back, you can't get that money back, right? So that's just the basic reason, right? The signing bonus should never go directly towards your student loans, right? It's just a bad use of that money, and it could be made even worse if for some reason you were responsible for paying that back. And for all the reasons that I talked about previously, every other area of your financial wellness will benefit more from that signing bonus once you clear those clawback hurdles, right? So when people receive, this happens a lot too with new grads recently. Thankfully, it's a great perk that's long overdue in veterinary medicine, but there are strings attached. So if you're going to receive a signing bonus, put that signing bonus into a high yield savings account. Make sure you really understand what those clawback provisions mean, right? And when you eclipse them, right? So every time you eclipse one of those thresholds, right? So maybe 50% of that money is yours after you complete 1 year with that employer, right? After you complete that 1 year, you can take that 50% of those funds after you've already covered the tax liability on it, if that hasn't happened, and start moving it into your other areas of your financial wellness, right? So jumpstarting those tax advantage retirement savings accounts, saving for the down payment on a home, using that to start a family or something like that, or to start a business, or whatever other things are going to generate a much higher return than putting it towards your student loans, right? Again, your student loans are going to get covered by your income, and you'll either hit forgiveness or you'll hit zero. The student loans should be kind of on the list of priorities of your overall financial wellness, really, really low, right? Because you have this super beneficial way of managing them based on your income. And no matter what happens, right? If your income goes up, your payments go up. If your income goes down, your payments go down, right? But your student loans are going to go away one way or another, right? So they don't deserve to receive that signing bonus. The rest of your financial wellness deserves to receive it first. Can you explain why making extra payments while on an income-driven plan like SAVE is bad? Would you be paying down your principal while your interest is being covered? Yeah, I wish it worked like that, but it doesn't. Right? That's why you can't make those extra payments while you're receiving the subsidy. So here's the example. I'll kind of come back to you're accruing $1,000 of interest. Your payment is $100. Your minimum monthly payment using SAVE is $100, which means you're receiving a $900 a month subsidy. You would think that if I paid an extra $100, that would actually go to the principal, but it does not. Right? The subsidy is contingent upon all payments that are made, right? So if you made an extra payment of $100 above the minimum of $100 that was already due, instead of receiving a $900 a month subsidy, you're going to receive an $800 a month subsidy. So by you paying that extra $100, all you did was reduce the subsidy by $100, right? You literally lit that money on fire. Right. So that's why it doesn't make sense for you to make extra payments while you're receiving that subsidy. Right. But it also gives you a really, really unique opportunity to use that extra cash flow while the Department of Education is covering your interest to jumpstart all of those other more valuable areas of your financial wellness. Right. And we didn't get a chance to get to those, but there's a lot of slides in here where I kind of list out what those financial wellness items should be. Right. So that's what these are, right? All of these things are way more important than accelerating your student loan payment. And I think I'll end it there. I mean, it's we're kind of at the 2 hours. You guys have been a really engaged group, and I really appreciate all of that feedback and the great questions. And again, we'll provide a link to this presentation, and you guys can click through any of the content that you want to revisit, or stuff that we may not have gotten to. There's a ton of stuff in here, but there's no way we could ever get to it in the 2 hour time frame. But any other questions that you guys have that I can answer while we still have while we're still here, that's what I would use this time for. But otherwise, I think we'll kind of pull the plug here and send you guys on your merry evening.
Thanks, Tony, so much. While we see if there's any further questions, just thank you everyone for joining. Thank you ACVIM for helping us to put on this whole series. It's been absolutely fantastic. So that's been wonderful to partner with them. There will be a follow-up email with this recording with the link to the CE form, so you can receive your CE certificate for this, as well as some other helpful information, including Tony's Prezi here, so that you have all of the links and the additional information there as well.
Very cool. Well, thank you, Rebecca. Thank you, Jordan. Thank you, ACVIM. This has been great. It's been something I've been wanting to do for years now, and I'm super happy that we had a chance to do it. Hopefully we'll be able to continue that and continue the conversation with you all. Feel free, please, again, pass this information along to your colleagues. The residency crowd is a tough one to wrangle, right? You guys it's like herding cats, right? So, you guys are going to have to pass this information along to each other, and then we're going to have to figure out a way to keep doing it, because just like students, you all finish your training and move on, right? So it's really hard to kind of build that institutional memory, if you will, on things like this, unless that information is being passed along consistently. So you guys can help do that by just pointing people in the right direction when they are struggling with their student loans, and making them aware that there are other alternatives to just throwing a bunch of money at it. All right, I don't think did I see any other, I don't see any other questions. Very cool. Well, thanks again, everyone, and have a good rest of your evening, and good luck in the rest of your career endeavors.